The market was screaming. In Chicago at 2:42 p.m. On May 6, 2010, a lone sell order slammed the floor like a grenade tossed into a bank vault. It wasn't meant to happen. The figure, $4.1 billion, a sell order so huge it should have raised alarms, been stopped or at least questioned. Yet it slipped right through. By 2:47 p.m., the Dow had plunged almost 700 points in a matter of minutes. Accenture shares were quoted at a penny. Procter & Gamble, trading around $60, briefly fell to $39.97. The market wasn't merely falling, it was shattering. This wasn't a crash. This was a detonation. And the fuse, it was lit by a mistake, a misplaced trade. A single instant of human error that turned a routine portfolio tweak into a financial firestorm. The trader blamed a man named Navinder Sarao, or so the story goes, because here's what you need to get. Sarao wasn't a Wall Street titan. He wasn't a hedge fund manager. He was a 36-year-old trader holed up in a West London bedroom, perched in front of 5 screens inside a modest semi-detached house. His weapon? Not a massive balance sheet, but an algorithm, one he'd spent years tweaking, testing, and perfecting. A tool built to bend markets in ways regulators hadn't yet caught up to. At 2:32 p.m. London time, Sarao's algorithm sprang to life. It wasn't supposed to fire a $4.1 billion sell order. It was meant to slip out tiny, rapid-fire trades designed to fool other algorithms into seeing selling pressure. A decoy, a bluff. Something, however, went awry. A fat finger error, a misplaced zero, a glitch in the code, whatever it was. At 2:42 p.m., a single order $4.1 billion worth of E-mini S&P futures hurtled into the market. The system couldn't cope. Liquidity vanished. Prices collapsed. Within minutes, the flash crash ignited. But here's the twist. Sarao says he didn't intend it. He claims he didn't even realize the order had been placed until it was too late. His defense? That his algorithm, built to spoof the market, spun out of control. That he was just another trader caught in the machinery of high-frequency trading, a cog in a system too fast, too complex, too dangerous to rein in. The SEC and CFTC would later dub it one of the most turbulent periods in market history. The NYSE called it a sudden depletion of liquidity. Scholars point to fragmented data feeds and feedback loops that turned a single slip into a global crisis. Yet none of that settles the core question. Was Navinder Sarao a rogue trader, a scapegoat, or simply the unluckiest man in finance? Because here's what we know for sure. On May 6, 2010, a single erroneous trade, $4.1 billion, ripped through the market like a digital tsunami. In just 36 minutes, about $1 trillion in market value vanished. And for the first time in history, a market meltdown wasn't sparked by greed, panic, or war. It was sparked by a mistake no one saw coming, a mistake that almost no one survived. So how does a $4.1 billion trade travel from a London bedroom to a worldwide financial crisis? And more importantly, who really lit the fuse? We're about to find out. Source: SEC Staff Report, 2010. The flash crash was triggered by a large sell order entered into the market by a mutual fund, which caused a rapid cascade of sell orders across multiple venues. Source: CFTC Joint Report, 2010. High-frequency trading amplified the price decline, but the initial shock originated from a single erroneous trade. Source: NYSE Press Release, 2010. The exchange experienced a sudden depletion of liquidity, leading to price dislocations that lasted approximately 36 minutes. Source: Reuters Investigative Article, 2010. A rogue algorithm placed a $4.1 billion sell order, which the market could not absorb, sparking the rapid plunge. Warning advisory: this is a documentary investigation. It contains depictions of market volatility and trading behaviors that may be distressing to viewers sensitive to financial loss. Always consult a licensed financial advisor before making investment decisions. Yeah, sure, everyone loves a good villain, especially when it's some faceless algorithm run amok. The old story goes that high-frequency trading single-handedly wrecked the market on May 6, 2010, turning a normal Thursday into chaos. But dig into the real numbers and you'll find something messier than that pop culture take. Turns out, it wasn't the machines that started the fire, it was a single human slip-up. A portfolio manager at a mutual fund keyed in a sell order so massive it dwarfed the liquidity floating around most exchanges at the time. That one mistake. It wasn't the spark, but it sure poured gasoline on the flames. The HFT crowd just stepped into the void once it opened. Source: SEC Staff Report. As soon as that monster order hit the tape, the market's depth got vaporized. The trade was tagged erroneous within seconds, but the damage, already done, rippling across exchange after exchange like a shockwave. The order was set up for a marketon close play, but the timing collapsed faster than a Jenga tower the second it started ping-ponging between venues in milliseconds. Source: Reuters investigative article. High-frequency traders didn't invent the problem. They just showed up to the party early. The CFTC's joint report puts it plainly. HFT activity amplified the price decline, but the initial shock originated from a single erroneous trade. Their lightning-fast quoting and order canceling didn't start the slide, but they sure deepened the trench, stretching a sharp drop into a 36-minute freefall. Source: CFTC Joint Report. Liquidity didn't vanish because some algorithm woke up and decided to bail. It disappeared because the market's plumbing couldn't keep up with the chaos of fragmented data. The NYSE clocked a sudden liquidity black hole that left price dislocations strewn across its own floor and beyond. When one feed screamed $5.00 and another whispered $4.90 in the same millisecond, the algos got whiplash pulling quotes fast to dodge getting stuck with bad fills. Source: NYSE press release. Academics digging into the wreckage say the data feeds were more like blindfolds. Without a unified snapshot of who was buying and selling, everyone relied on stale snapshots or half-baked glimpses. Those half-truths fed straight back into the system, cranking the dial on the sell-off and turning one big order into a full-blown meltdown. The study calls it a feedback loop that accelerated price drops. Source: Academic Journal article. Regulators have spent years unpacking the wreckage, and their take is blunt. A top CFTC official told investigators, "The market's architecture let one bad input run wild." A former NYSE ops manager put it even plainer. "Our risk controls were built for a world with one clean data feed. Instead, we lived in a patchwork of feeds that left gaping holes." Their stories don't clash, they both point to the same flaw. The market's fragmentation, not just its speed, was the real tipping point. The myth that HFT is the lone boogeyman sticks around because it's tidy, black and white, and perfect for headlines. Dig deeper, though, and the flash crash looks less like a villain movie and more like a three-car pileup. First, there was that oversized, wrongly typed sell order. Then, the data feed splintered into a hall of mirrors. Finally, the algos programmed to bolt at the first whiff of vanished liquidity piled on. Each piece fed the next, and no single player could claim to have steered the whole disaster solo. Want to picture how that monster order spun out of control? Imagine a trader trying to exit a position gently before the closing bell. A coding typo flipped the script. What should have been a limit order turned into a market order with a sky-high price ceiling. The moment it hit the first venue, automated stop-losses on other platforms fired off like dominoes, sending more sell orders tumbling after it. The spiral spun faster than any firm could hit the brakes. The SEC's postmortem lays out the cold facts. The order's size, its price cap, and its routing logic were all out of sync with the market's actual state. The report hammers it home. The flash crash was triggered by a large sell order entered into the market by a mutual fund, which caused a rapid cascade of sell orders across multiple venues. No malice. Just a me's-wired algo operating in a world that couldn't keep the lights on. Data feeds didn't just lag, they lied in real time. Some systems screamed plunge, while others barely blinked. That split vision pushed algos to send mixed signals. Some yanked quotes, others piled in, and the whole dance destabilized the market even more. The same academic study we cited earlier puts numbers to the effect, calling it a feedback loop that accelerated price drops. Regulators weren't shy about blaming the system, not the players. A CFTC panelist admitted, "Our risk models assumed one clean data feed. Reality gave us a patchwork of feeds that left blind spots our models never saw." An exchange insider put it this way: circuit breakers triggered because the big picture arrived late, not because any one venue went rogue. After the dust settled, the fixes aimed squarely at the plumbing. The SEC and CFTC jointly pushed exchanges to adopt a single, authoritative price feed, one source of truth to cut through the noise. The goal: shrink the gaps between venues so a rogue order can't get lost in translation and snowball into another crisis. So here's the real lesson from May 6, 2010. One human typo, magnified by a market that couldn't see straight. The myth of the rogue algorithm is simpler, but the truth is uglier. The real failure wasn't speed. It was the fractured data feeds, the routing logic, and the risk controls that couldn't sync up when it mattered most. Pull together the SEC files, CFTC reports, NYSE memos, academic papers, and investigative deep dives, and the conclusion is the same. The architecture itself failed, and fixing it starts with clearer, faster, single-source data. The screen locks on one still image. Watch the Dow Jones tumble 600 points in just minutes. The timestamp shows 2:42 p.m. Eastern on May 6, 2010. The flash crash wasn't Mother Nature's doing. It was a failure in the system's design. Source: SEC staff report a mutual fund placed what ought to have been a routine sell order. Instead, it set off a cascade sell orders piled up across every exchange in mere milliseconds. Source: CFTC joint report. High-frequency trading didn't light the fire, but it certainly fanned the flames. The issue wasn't the trade itself. It was the system's sheer inability to soak it up. A split screen appears. Left side shows the mutual fund's $4.1 billion sell order spilling across fragmented markets. Right side: price quotes vanish, liquidity just evaporates. Source: NYSE press release. The exchange suddenly lost the ability to price the market coherently. In this video, buyers simply disappeared. That wasn't a simple liquidity drought. It was a drought of data. The market runs on information, plain and simple. But on May 6, that information was outright false. Source: academic journal article. Fragmented data feeds meant traders were seeing different prices at the same instant. Take Procter & Gamble, for example. It traded at $39 in one venue and $60 in another. That gap wasn't a mere pricing error. It was a full-blown pricing breakdown. The flaw wasn't just theoretical. It was evident right on the trading floor. Regulators had already been warned. Years earlier, studies showed split-second data gaps could destabilize markets. Yet when the crisis struck, the reaction was reactive, not preventive. A timeline flashes. 2008, SEC proposes consolidating market data. 2009, industry pushes back. May 6, 2010, system collapses. Source: Reuters investigative article. The rogue order exposed the weakness, yet that weakness had been there long before. That flash crash wasn't just a glitch. It was a symptom of deeper issues. After the crash, regulators scrambled to respond. Circuit breakers got introduced, but the core flaw stayed untouched. The market kept running across 50 fragmented data feeds. Those same dislocations could and did reappear in 2020 during the COVID-19 sell-off. Source: SEC staff report. The report concluded, the initial shock stemmed from a single erroneous trade, but it never asked why the system couldn't contain it. The question wasn't who caused the crash. It was why the system was so fragile that it couldn't survive a single trade. Today, the market is faster, more complex, and decidedly more opaque. The lessons of 2010 never got fully implemented. The next crash isn't a question of if, it's a question of when. And when it does happen, the data feeds will still be fragmented, liquidity will still vanish, and regulators will still be playing catch-up. The flash crash of 2010 handed investors a stark reminder. A single bad trade can expose how fragile the market really is. The SEC staff report pinned the spark on a huge sell order placed by a mutual fund, which set off a chain reaction across trading venues. Source: SEC staff report. High-frequency firms rode the wave down, yet the real culprit was a lone rogue algorithm that dumped a $4.1 billion sell order the market simply couldn't swallow. Source: Reuters investigative news article. When liquidity disappears, prices can stay out of whack for minutes, about 36 minutes in that flash crash, to be precise. Source: NYSE press release. That fragmentation spawns feedback loops that speed up the drop, a pattern scholars have traced in market data feed studies. Source: Academic Journal article. The fallout isn't limited to one day. Investors now have to push for clear, synchronized data streams and sturdy safeguards against rogue algorithm spikes. Regulators are already looking at data integrity rules, but without a groundswell of public demand, reforms tend to stall. Backing legislation that mandates real-time cross-venue data checks could cut the odds that a single trade sparks another market-wide plunge. The joint CFTC report verified that high-frequency trading amplified the fall, yet it stressed that one erroneous trade kicked off the cascade. Source: CFTC joint report. Investors should keep an eye on order book health, flag sudden depth drops, and ask exchanges to publish real-time liquidity numbers. Only with open data can we dodge a repeat of the 2010 turmoil. The time to act is now. Write to your reps, join industry coalitions, and demand that exchanges tighten data integrity protocols. Your voice can shape a market where speed is matched by reliability. By staying vigilant today, we lay the groundwork for a safer market tomorrow. If you'd like deeper dives into the forces reshaping our financial system, hit subscribe and turn on notifications. Together, we stay vigilant, stay informed, and protect the integrity of the markets we trust.